All right, joining us live from the Chicago Board Options Exchange, Jud Pyle, portfolio manager for PEAK6 Advisors. Jud has 15 years experience trading, analyzing, and risk managing equity options and other derivatives positions as well. Also with us from Cincinnati, Nick Sargen, Chief Investment Officer at Fort Washington Investment Advisors. Nick currently oversees $35 billion in assets. He previously worked for the San Francisco Federal Reserve. Gentlemen, thanks for joining us today. Nick, let me start off with you. We're creeping ever closer to the 1251 level. Just telling Dom and Julie, I woke up and thought about it 2 weeks ago and thought, why doesn't everyone buy it? Because we're going to hit it anyway. But every day we just seem to inch up a tiny bit, and we're not making it there. What's the problem?
Oh, Matt, I don't think it is a problem. In fact, the way I look at things, think of where we were at the end of August, or think even where we were around the congressional elections. You never would have anticipated this powerful a rally. So my reaction is that it's been a huge move, and you get close to key numbers. Markets may, hem and haw for a bit. But I think that the key question is, are there fundamentals supporting this rally or not? And I'm on the side that, yes, there are.
And Nick, we're going to talk about those in a moment. But Jud, let me bring you into this conversation. I mean, do you feel like we're getting ready, though, for a bit of a pullback? I mean, I'm kind of shocked to look at the run-up here in December, almost 6% here. Is it kind of ripe for some kind of pullback?
It might be ripe, Carol, but I don't think we're going to get the sell-off, at least in the next 2 weeks. And the reason is because when you've got this level of kind of thin trading, you guys have mentioned it kind of all day, we're going into the holiday season. There's just really no reason for people to take risk and sell. And so the buyers are in control. And when you've got that, I think we'll hold these levels to move higher. Now, when we get into January, I think earnings will be decent, but that'd be when people might start to rebalance a little bit if we're going to get some sort of a sell-off.
And Nick, let me ask you, because you talked about the fundamentals that are improving. I mean, you were surprised by the rally that we've gotten earlier this year, but you do see things getting better.
Definitely. Just think of where our perception, first of all, of where we were. Third quarter numbers now for GDP are probably going to be about 3%. The original estimate was 1.5%. That was when everybody was talking deflation, double dip. Now you go into the fourth quarter and you're going to get even stronger. And I think what's the key is that, this time a year ago, everybody got excited. We had a 5% figure posted for fourth quarter GDP, but most of that was inventory. The difference this time is that it's more broadly based consumer, business equipment, and exports. And then, last but not least, you get the stimulus package that is going to add impetus next year, whereas, of course, in the beginning of this year, we had stimulus being withdrawn.
Hey, you talk about deflation and double dip, like you got to be crazy to believe that would happen now, right? But we had Ben Bernanke on 60 Minutes just a couple weeks ago. You hope he's one of the smartest people in the entire country. And he was talking like he has to go through with at least the $600 billion in QE2 just to save us from the possibility of deflation. I mean, is it that perilous, or does he have to even go through with it?
Well, my judgment that a lot of people are critical. I thought he should have kept it in his hip pocket in case we need it. I think the evidence today suggests you don't need it. But, that said, Matt, the way I look at things is he is, when people say to me, well, why are you confident that we won't see deflation? I'm going because Ben Bernanke says he's not going to let it happen on his watch. I don't think the risk is that great. But given that he's still fearful, that makes me more confident it won't happen.
I definitely see more confidence, at this point and looking into early next year. But folks are a little bit worried about how things play out. We actually caught up, everybody, with Tobias Lekovich. He's the chief U.S. equity strategist for Citigroup. He told us earlier today about what kind of he sees as we head into 2011. Let's listen into this.
There's definitely more confidence showing up in the business community to spend some money and hire some people and get things going. So I think we're going to get that bolstered in the first half. It's beyond that. As we move to the second half, kind of think around mid-year, we may see some margin problems start to crop up, and markets will care about that in a more negative fashion. So it's a bumpy ride.
So, Jud, you anticipating a bumpy ride next year? I mean, is it the second half that we have to start worrying about because things could start to change?
Absolutely. I think you're going to get fourth quarter numbers out in January, and they'll be decent. And as Nick has alluded to, you've got decent macroeconomic circumstances, and so that basically, when you've got that plus decent dividend yields, stocks look really attractive. But certainly from a volatility standpoint, we're more susceptible in the marketplace to those types of swings. So I think what Tobias was saying is very reasonable for sure.
Hey guys, earnings, we're getting a little bit here, and then we'll kick back into earnings season again next year. Corporations, they still have pretty healthy balance sheets, don't they, Nick?
Oh, absolutely. They're sitting on mounds of excess cash. But then again, I'm in the camp that where I was getting nervous, say toward the end of this year, earlier, was that I was saying a lot of this has been driven on earnings by margin expansion. And then, we were getting to highs that we hadn't seen before in terms of from an overall, economy standpoint. So I think that the one hope now that I have is if the consumer indeed is kicking in. And what do we mean by that? We're just saying, does the consumer spend at a 3% rate instead of a 2% rate? But what that would do is that would boost the top line. I'm not banking on further margin expansion. I'm just saying that top line growth then falls to the bottom line. So I do believe there is a basis for upward revisions. And I agree, though, that the test of how far we can go, I think, is really a mid-year phenomena where could the economy lose momentum mid-year? That's up for grabs.
Hey, Nick, speaking of consumer spending here, we had Ford come across with some great headlines here about how they're seeing some auto sales numbers that are better now than they were during cash for clunkers. Perhaps speaking to this broader theme that even when the government steps away, private demand can pick up here. Do you think that's going to be a theme that continues in 2011, or is this kind of like just a one-off instance here at the end of 2010?
No, Matt, I think that it's a possible theme. When we all know the balance sheet problems, that's old news. So the real issue is, where are we today? And I think that if, I look at how consumers have adjusted, their saving rate now is between 5 to 6%. They may go higher, but they've come a long way from 0 to 2. But then you look at their debt service burden. I'm taking the interest payment into account. That's come down as a share of their income. And now their personal income growth is expanding. So I do think that there is more basis for the consumer to stay in the game, whereas before they were banking on more government, programs to boost spending.
I got to ask quickly, because if you were right in saying margins versus revenues, good thing to discuss. How much does the U.S. corporation push for revenue expansion if it's already sitting on so much cash? Do you do things like free shipping, even though it cuts down on margins, to boost your client base?
Well, I think that the real issue is, in terms of employment, you get discouraged when you see the unemployment number. You get encouraged when you see the weekly jobless claims coming down. And what I think is that businesses have pushed the existing workforce about as far as it can go. So if there is more final demand, I am more hopeful that we start to see job growth.
All right.
Nick and Jud, thanks so much for joining us.